I worked as a hiring manager for over a decade in one of the most reputable firms on Wall Street. And you want to know what my favorite interview question was? It was this: take the most sophisticated financial concept you know and explain it to me like I don't know anything about finance. Now, that's the best interview question I know. I learned it from an extravagant BSD on our floor. It's a tough question because the person that I'm interviewing knows nothing about me. So in most cases, if they're competent, I'll learn something, right? They'll explain some sophisticated financial concept and I'll get something out of it. Now, all I came to the table at that time was with an MBA, so I knew very little. Later on, I did my master's in finance. But good candidates would be able to navigate through this question, and it just underscores the entire approach that we take here at Nanalyze. We never assume that someone watching our content knows anything about finance. So today's agenda, we're going to try to answer a key question here. Is NVIDIA overvalued? We're going to look at two methods of valuing NVIDIA, so revenue ratio and profit ratio. As I said, assume everyone knows nothing about finance, and since valuation concerns price, using both those ratios, we're going to look at that first. So here's the shock and awe chart that people will throw up, and it's we say it's very important to always use a benchmark when you're showing returns, so you have something to baseline against. But if your returns are over 100,000%, then that might be an exception to the rule. So to figure out NVIDIA's returns, a good way to do that is to go back to when they had their IPO. And here you can see this article from the Wall Street Journal. And it says, this was almost 25 years ago, that when they had their IPO and shares closed that day at around $20, that they had a market cap of $626 million. So a pro tip here, always use market caps to calculate return, because that's going to take into account things like share splits or dilution, or a company buying back their shares. So let's do the math here. $626 million back then, a $1.78 trillion market cap today, and you get a return of 284,517%. So put that into context. A $1,000 investment would be worth $2.8 million today. And you're looking back, it seems like that would have been easy to do, but it's very difficult to achieve superior returns in the stock market, as we all know. So NVIDIA happens to be our largest holding, and we've written about it extensively over the years. It's all there. We have all the receipts. And our last piece was rather timely and a fun one to show off. It says, NVIDIA's growth is stalling. Why we're not worried. And that was shortly before they had that big bump in generative AI hardware sales. So if you're interested in reading these articles, I'm just going to point you to a link here that takes you to a subscription page so you can read all our research pieces. I think we have over 2,400 research pieces we've written over a decade, and you can read them for free for a month, and it's $15 a month afterwards. So that's one way that you can help support this channel. So there's three reasons we would sell NVIDIA, the purpose of that piece that I just talked about. They are when growth stalls, so we're going to exit. This is the rules that we have for any of the 37 disruptive tech stocks we're holding. Growth stalls, we're out of there. That's why we're invested in disruptive growth. When our thesis changes, we exit. So again, these can be very subjective. So that's why we'll do an entire piece around them and evaluate whether or not these criteria are true or false. And then when it becomes too overweight, we'll trim. So we've trimmed NVIDIA a lot over the years because it's consistently overweight in our portfolio. So we have a proposed rule here that would be nice if somehow they could enforce this in all social media venues. You're not allowed to cite any valuation ratio in public unless you calculated it yourself. Now, this is far easier said than done. And it's why we came up with our own simple valuation ratio, which proves this. Now, even though we came up with this and we use it all the time and everybody in our community does, we all make mistakes. So our community quickly catches these because they're also doing the math. So let's look at simple valuation ratio. It's market cap divided by annualized revenue. So you can see, and we've taken NVIDIA's market cap, their last quarter revenues times 4, we get a number, 24.55. Well, what does that mean? Well, we'll show you in a second, but let's talk about this ratio. So it's like price to sales. It's but different. So as they say on the banana pancake trail in Southeast Asia, some vendor trying to sell you a North Face jacket. Same, but different. This ratio doesn't work so well with seasonality, obviously, because it uses last quarter annualized. In that case, you can just switch to a rolling 4 quarters. Doesn't happen very often. It's very responsive to new data, which is why we use the annualized number. It doesn't consider enterprise value, which perhaps a traditional price to sales ratio would. That's because we want to keep things very simple. Anyone can calculate this easily by going to Yahoo Finance and looking up 2 data points very quickly. It works well for disruptive tech. Why? Because most disruptive tech companies aren't profitable. You can't use PE ratio, right? PE, price to earnings ratio, looks at profit. So we've actually plotted this now for over 180 stocks in our catalog, our tech stock catalog, which contains 460 tech stocks. And here you can see the history. So we just added this in our last product release. It works out quite well. So I just pulled this from our catalog, the data. You can see NVIDIA's historical SVR. Remember, we said it was 24.55, right? So the average has been around 20 over the past year. Our catalog average, so for all 180 stocks we calculate this for, is about 6. So we have a rule internally. We say we don't invest 3 times our catalog average. Well, that'd be 18. So this is too rich to invest in. However, you can see that dip there down below 15. Well, what our community does, they'll use this SVR for valuation targets. You'll say something like, you know what? I'm only going to buy NVIDIA at an SVR of less than, say, 15, right? And you would be quite good if you picked that and were able to. And you have to watch these, right, if you're able to buy at the bottom like that. But it actually works quite well. So let's talk about price to earnings ratio. And this is something that we don't use, and we're going to show you why. So when we look at the ratio, it seems very simple. You have the share price divided by earnings per share. But what's earnings per share? So we're talking last quarter. We're talking the average of the past 4 quarters. So let's do some simple math. Now, what we're going to do is start by looking at earnings per share for NVIDIA over time. And what we see here is that we have an obvious outlier. So the chart on the bottom is just quarterly earnings per share. You can see recently they've spiked. And then the chart on the top there is the trailing 12 months. Well, even though it's smoothed it out, it's still rather extreme. So the first thing we want to do is calculate price to earnings ratio, right? We got to be able to calculate the ratio to use it. So I pulled this from Schwab, and I'm not going to use this because not everybody here uses Schwab, but I just wanted to point out that they're calculating it differently from Yahoo. We use Yahoo Finance for most our data calculations, except for our internal investment products, because anybody can access it, right? So here you see they have a P/E ratio for NVIDIA of 92.56, a forward P/E of 58.4. So we're going to talk about both of those. So when we go to Yahoo Finance, of course it's different. Yahoo says it's 95.16, not that far off. First thing we want to do, replicate that, all right? So we gave that a stab using data that we found for earnings per share. I think it was taken from Macro Trends. All right, we came up with $8.69. We took the last 4 quarters earnings per share, added them up. Then we took the market close price, and we got a value of 83. Well, that's not matching, right? So then we said, well, maybe it's pre-market since NVIDIA started trading this morning. So it came out 84. That's not right. So then we thought, well, let's take GAAP, and because the other data values were non-GAAP. And sure enough, we add up all the GAAP numbers, and we almost get exactly what Yahoo Finance came up with. Good, we're all talking the same language. But what does this number even mean? Well, the first thing we need to do is find an appropriate benchmark that we can compare this to. For example, what does the Nasdaq trade at? So the collection of technology stocks that represents the Nasdaq, what do those all trade at? What does a basket of peers like a semiconductor index trade at? Or you can even say, what does this look like relative to what it's been in the past? And that's this chart here taken from Macro Trends showing the historical PE ratio for NVIDIA. And you can see it's rather high, and it's been spiking lately, of course, on all the hype. So the next thing we want to do in order to put some value to this number, as I said, is find a benchmark. And we've done that here. So this is taken from the Wall Street Journal. You can see for the Nasdaq 100 index, we have a PE of 31.72. Let's call it 32. So now we have a benchmark. Now, what's important to do is say, well, the PE ratio for NVIDIA is so high, but what are they expected to do in the coming year? So there's remember, we saw all that lumpiness and the outliers there. What's the expectations going forward? And how financial professionals handle this stuff is they'll typically look to analysts to have done that work for them. So they say, what do the analysts think? Again, the data taken from Yahoo Finance, and this nice table shows us some interesting information. We have low estimates and high estimates. It looks like from 37 Wall Street analysts, and that's for next year, 2025. Cool. So let's take the midpoint, the average, right? So if we take the 2889 plus 1508 and then we divide that by 2, we get a midpoint of $22 in earnings per share, $5.50 earnings per share per quarter. Great. Now we can do some more math. So if we can also use as a point of reference Yahoo Finance's forward priced earnings. Look, theirs is 35.59. So that's a lot different from that 95 number, isn't it? So when we calculate this, we use the current price, 721.28, divide that by 22, and we get 32.8, and we can compare that to Nasdaq at 31. So in that respect, you could say, well, NVIDIA's fairly valued based on a price to earnings ratio that looks at expectations for 2025 at a midpoint of what 37 analysts think. See, so it's important to note that you can always torture the data and make it say anything you want. So if you wanted to be bearish, you could lower the guidance numbers you're using. If you wanted to be bullish, you could raise them, right? And play around with that. Using the midpoint, I think, is fair. So some other things to consider here. NVIDIA has a history of beats, but let's forget about that for right now. Is the midpoint we used fair? Well, as I said, it's the fairest thing that you could do. And who are these analysts anyway? So one of the things here at Analyze, we never pay attention to forward-looking data from analysts. It just has very little meaning because we know how that stuff gets constructed, right? There's a lot of people talking out of their ass most of the time. So a fair amount of the time. We're talking earnings per share here, not revenues. And what can happen for a growth company? And NVIDIA, you classify growth and value based on metrics and financial data. Companies like MSCI do that, right? So NVIDIA is arguably a growth company, and when they move more towards value, they can go into cost-cutting mode and then boost earnings per share, right? This boom in AI hardware, of course, is only going to last so long, so we'd expect to see a contraction at some point, and then for us, growth stalled. Well, we need to see that growth resume in several years or less in order to, as I said, not break that earlier mentioned rule. Paying attention to other parts of NVIDIA's business is very important right now because that's going to help supplement growth when the AI hardware boom tails off. So to summarize, we've talked about and shown you why a simple price to earnings ratio can actually be very complex. Just being able to validate one from a data vendor is tough. So as I said, you can always torture that data and make it tell people whatever you want. So it's important to try to be objective when you're considering these things. Now, we've made a reasonable case to show you that NVIDIA isn't overvalued based on expectations for next year. But guess what? That and $50 might get you a lap dance at Mustang Sally. So, of course, all these, these forecasts and things like that, you have to take it with a grain of salt. What these ratios are very useful for, though, is making sure you don't overpay and setting some rules as to, I don't invest in companies that are past this particular ratio cutoff. So I'm going to put up another video here that you might find interesting. Before you click that, please like this video, subscribe to our channel, support our work. Thanks so much for taking the time to watch this today.